In this video, I'm going to talk about balancing the contributions between the Roth IRA and the 401k. So if you're looking to reduce your taxes and maximize your retirement plan, this video is for you. But before we do, if this is your first time at our channel or you haven't subscribed, click on the subscribe button at the bottom. My name is Travis Sickle, certified financial planner, helping you reach your financial goals. So let's figure out how to balance between the Roth IRA and the 401k so you can reduce your taxes and maximize your retirement plan. But there are several factors that you need to be aware of, which I'm going to go through in just a minute. But before we do, I'm going to literally paint the picture for what I see happen all the time when we're trying to balance between the Roth IRA and the 401k. So we contribute to the 401k up until the match, and then we flip it all over into the Roth IRA. That's what I see 99% of the time. And that's because we look at the Roth IRA as the holy grail of retirement plans, and then every dollar should go in there because it grows tax-free. But that's not entirely true for everybody's situation. Now, it might be right for you at the end of the day, but you're going to want to pay attention to these factors to make sure that you're maximizing your retirement plan and, of course, reducing your taxes. So those factors that are affecting this, the first factor is going to be your taxes. So we want to reduce your taxes as much as possible. And then we want to look at your deductions. Now, putting money into the 401k is an income deduction. So we're going to look at deductions. Then we're going to jump to the standard deduction. Now, those changed with the 2017 Tax Cuts and Jobs Act. So we're going to take a closer look at how those are benefiting you and how you can use them to your advantage. Then we're going to take a look at the credits you might be leaving on the table, and of course, how much you can save. That is a huge factor in figuring out how you're going to balance between the Roth IRA and the 401k. So let's start with our taxes. So the 2017 Tax Cuts and Jobs Act has totally changed tax brackets, the standard deduction, and really how we go about everything tax-wise and planning-wise. So let me pull up on the screen the 2019 tax brackets, and you can see them here. Now, across that first column, or the first row, we see the standard deductions, the SD. So the standard deductions for someone that's single is $12,200. For married filing jointly, $24,400. Most are going to be under those two categories, but we also have married filing separately at $12,200, which is just the same as single, filing single. And then we have head of household at $18,350. So the 2017 Tax Cuts and Jobs Act made it so these standard deductions simplified millions of tax returns. So previously you had to itemize in order to get that amount of write-offs on your taxes. Well, with the 2017 Tax Cuts and Jobs Act, these numbers can be applied right off the bat. So if you don't have that amount of itemized deductions, which you probably don't anymore, then you're just going to take the standard deduction and be done with it. Makes life a lot simpler and also much more beneficial. So let's go through an example of how you can apply the standard deduction and balancing between the Roth IRA and the 401k. So let's assume that we're going to go with a single filer. And I'm going to go through two examples, single and married filing jointly. So the first one that we're going to go through is single. So let's assume that we're making $55,000. Go back to the tax brackets, that's $12,200. So let's subtract that. 55,000 minus 12,200, that's going to leave us with $42,800. Now, a lot of 401ks have either a 3 or a 4% matching. So let's use that as an example. So let's assume from 55,000 that we're going to save 3%. That comes out to $1,650. So because we're putting it into the 401k, it's pre-tax. So the amount that you're taxed on is now reduced by that amount. So now we're down to, or subtracting $1,650, bringing us down to $41,150 in total taxable dollars. Now let's go back to the tax brackets for just a moment. With $41,150, that puts us in the 22% tax bracket. But look how close we are to getting to the 12% tax bracket. So if we save an additional $1,675, because all I'm doing is looking at the 12% tax bracket, looking at the upper end of it, which is $39,475, and subtracting it from $41,150. That gives us an additional $1,675 that we need to save. So you can see those two numbers. You can see we originally saved $1,650, but if we increase that by an additional $1,675, look back at the tax brackets. We're in the 12% tax bracket now, no longer in the 22% tax bracket. So we've saved 10% on each dollar that we contributed into the 401k. So for each of that $1,675, we'd effectively saved 10 cents on the dollar by doing so. Now that's assuming in retirement we're in the same spot, which we're going to go into in a little bit. But let's go into the second example first, married filing jointly. So married filing jointly, let's use the same example and let's just double the numbers. So we're going to use 110,000 married filing jointly. Now it doesn't matter if you each make 55,000 or if one earner earns 110 and the other one's a stay-at-home spouse, it doesn't matter. The married filing jointly is an aggregate number, meaning they're just added up. So let's use 110,000. So the same example, 2019 tax brackets say that's $24,400. So 110 minus $24,400, that leaves you with $85,600. If we save 3%, that's $3,300, giving us a total of $82,300 in taxable dollars. We're going to do the same thing. We're going to look at the next closest tax bracket below us, which is the 12% tax bracket, and that's $78,950. So we're going to do the same math, and that's going to leave us with $3,350 more that we need to put into the 401k. Now, if we do that, we're going to save an additional $3,350. We're going to have the same effect. We're going to go from the 22% tax bracket all the way down to the 12% tax bracket. So it's a huge jump. Now, take a look at the tax brackets for a moment. You can see that if you make anywhere in between the 22 and 24% tax brackets, which is a huge range, from $78,951 to $321,450, that's not a huge amount. Now, you're still saving 22 cents or 24 cents on the dollar if you're putting into the 401k and you're in those tax brackets. You're just not completely getting out of those tax brackets into the lower tax bracket. I know that might sound a little confusing, but you're saving a ton of money for each dollar that you can put into the 401k. Now, you still don't want to just look at it from this perspective, because then you would assume to put all the money into the 401k because it's just going to help you reduce your taxes all the way. And that might not entirely be true or the way that you want to do it. There are other factors that you need to consider. This is just one of them. Now, because the 2017 Tax Cuts and Jobs Act had such a huge impact on your taxes today and how you should plan, we really need to go through an example of comparing contributing into a Roth IRA versus a 401k and how that looks from a tax perspective. So if we're going through this opportunity or this example, we're going to compare the 401k to the Roth IRA. So let's just put out an example of saving $100. If we put $100 into each account, so we're going to look at it from the beginning, so before it's taxed. So if we put $100 before it's taxed into the 401k, nothing's going to be taxed because the 401k is pre-tax. So that means the full $100 is going to go into the 401k. Now, if we have the same investment return, this is really important. You got to put things apples to apples. If you have the same investment return, and let's just say hypothetically that your investment doubles. So it's going to go from $100 to $200. So now let's fast forward into retirement with that same $200, and let's assume that you're in the 24% tax bracket. Well, that would leave you with $152. Now, the same thing for the Roth. The $100 that goes directly into the Roth goes in pre-tax. So in reality, you're putting in 76 cents because we're in that same tax bracket of 24%. So 24 cents minus $1 or $100 leaves you with $76. Now, if that same investment that we used in the 401k, we apply it to the Roth IRA and it also doubles, so 76 times 2, doubling, would be $152. And if we pull it out in retirement, we know that comes out tax-free in retirement. So you can see right here, you have the same amount of money as long as you're in the same tax bracket. So it's really important to try and figure out or have some idea of where you are today and where you're going to be in the future. Now, we don't always know where our tax bracket's going to be each and every single year, but you have an idea of the industry that you're in, how much you're earning, how much you earned in the past, and kind of using your best estimates or your best guesses on where you're going to be as far as income goes. So the idea or the strategy behind this huge opportunity is to smooth out your taxes. So if you do have a year where the taxes are really high, then you're going to want to put more money into the 401k. But on the other side, if you think taxes are going to be low, then you might want to put more money into the Roth IRA. Now, because the standard deduction is so high relative to other years and tax brackets in general are low relative to other years, you might want to consider putting more money into the Roth IRA, but not blindly. Just look at the examples I went through. By increasing our 401k, we were able to capitalize on that opportunity and lower our total taxes, put more money in your pocket. Now, going back to the examples that I just mentioned, if you looked at those same examples in today's situation, you'd have gotten in a lower tax bracket than you otherwise would have if you just put it into the Roth IRA. So this is a huge opportunity if you're running with projections. So it really comes down to where you think your income's going to be. Do you have a smoothing, or do you have an increasing income? Is your income going down? Is it a spike year? Is it a down year? You really have to figure those things out before you can make an educated decision on where you're going to put it, into the 401k or the Roth IRA. Now, the next thing you want to take a look at are the credits. Now, in no particular order am I putting any of these bullet points in here, but you really want to take a look at the credits that you may or may not qualify for, just like your tax brackets, to see what else you can do. Because even if you use software like TurboTax or you're just doing your taxes yourself, just because you're going through things and it says, would you like to save additional dollars? What it's not telling you, what software usually doesn't tell you, is should you go back and make an adjustment to your 401k contributions in advance? It's not doing that planning aspect. It's more of a reactive plan than anything else. Hey, would you like to save additional dollars? Now, if you're looking at your bank account and saying, well, I saved as much as I could, so I can't save any more, you might have been able to save more efficiently. That's why it's so important to look at all these factors in advance rather than waiting until the last minute or right before you're filing your taxes, because to make those adjustments is not always possible. And the last factor that's going to affect how you should balance between the Roth IRA and the 401k is how much can you save? How much are you going to put into these retirement plans? If you can only put 3% of your salary, you might choose putting into the 401k to get the free match, the free money. Why not? Or if you want to save $25,000, you might find that you can maximize both plans. You might be putting it into the 401k and the Roth IRA. But what if you don't qualify? There are other planning techniques that you can use in order to get money into the 401k and the Roth IRA, and of course to maximize your retirement plan. So it really depends on your particular situation, not just based on income level, but also your ability to save, what your goals are, where your taxes are, your income projections. There are just too many factors to use one strategy for every single person. So the next time you hear you should only save into the Roth IRA or the 401k, they're probably wrong because they're not looking at your particular situation. So you really want to look at everything. If you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.